Hello everyone and welcome to Conceptnomics. In this series, we are discussing questions asked in the UPSC Civil Services examination from Indian economy. In this video, we'll be discussing 2022 questions asked from Indian economy. The total number of questions are 18. We'll be discussing mostly the conceptual questions. So let's get started. Okay, the first question. Rapid financing instrument and rapid credit facility are related to the provisions of lending by which of the following? Now, four options are given: Asian Development Bank, IMF, International Monetary Fund, United Nations Environment Program Finance Initiative, and World Bank. Now, the four options given here are all very popular international institutions, and you should know at least the basic things about these four institutions. UPSC is expecting from a candidate that the candidate should know at least minimum about these four or more number of important financial institutions or international organizations. Now, if you see Asian Development Bank or the ADB, the purpose is to give developmental finance. Second one is IMF or International Monetary Fund. Now, what is the purpose of IMF? We have often heard that IMF or International Monetary Fund provides loans to those nations which are facing balance of payment crisis. And you should be also knowing about the 1991 crisis that India faced, and IMF had helped India during this 1991 BOP crisis. So, the purpose of IMF or the most important function of IMF is to help those countries that face a balance of payment crisis. The third one is United Nations Environment Program Finance Initiative, that is UNEP's finance initiative, and purpose is to finance various environmental projects. Now, World Bank also provides developmental loans to countries, especially to developing countries or least developed countries. They have different wings for that. Now, here the question is rapid financing instrument and rapid credit facility. Now, if you notice in these two terms, there is a term called as rapid, which means very fast. So, rapid means very fast. Now, if you see the first option and the last option, ADB and World Bank, you see that these two are developmental banks and the purpose is to provide developmental loans. And which do you think which has to be dispersed immediately, or which is of urgent in nature, or there is some fast or rapid thing involved here? No, right? Because developmental projects are well planned and then well executed, which means the finance will also be planned and then provided. Now, coming to the third option, UNEP Finance Initiative. It is again developmental loans given, but for environmental related projects. Again, developmental loans, all these things. Now, if you see the second option, that is IMF. The purpose of IMF is to help those countries facing a severe BOP crisis or balance of payment crisis. Now, see, the balance of payment crisis can be immediate, even though there should be a background and but at the same time, this can be immediate as well. Like, for example, how India faced the 1991 crisis. So, we can say that there were several factors that led to 1991 crisis, but there was an immediate trigger like the Gulf War and the disintegration of the USSR. So, the effect was also very rapid and which actually provided a situation that we needed immediate help or rapid help. So, rapid and IMF can be well connected because BOP crisis can be rapid, and during such situations, every country that undergoes such kind of crisis will need rapid financing or credit facility or immediate help, which can be given by IMF. So, answer for this question is B, IMF is the answer. Now, next one is a conceptual question. Let's see the statements. An increase in nominal effective exchange rate indicates the appreciation of rupee. So, first statement says that when there is an increase in NIR, it is equal to appreciation of rupee. Now, an increase in real effective exchange rate, that is in REER, indicates an improvement in trade competitiveness. Now the third statement, an increasing trend in domestic inflation relative to inflation in other countries is likely to cause an increasing divergence between near and rear. We need to analyze these three statements carefully, and this is a conceptual question. Before we move into the question, let us quickly see what is the concept of near and rear. Now, before we discuss near and rear, let's quickly see what is an exchange rate. Exchange rate means the rate at which your currency, that is your domestic currency, so in case of India, it is rupee, the rate at which the domestic currency can be traded with a foreign currency. Let us take for example dollar. Now to put it simply, we can say that the exchange rate between rupee and dollar is such an amount or such amount of rupee or quantity of rupee needed to purchase $1. Now exchange rate would be how much rupee or what is the quantity of rupee required to purchase $1. Let's say for example 85 rupee. 85 is to 1. If we say that the exchange rate is 85, it means that we need 85 rupees to buy $1. This is the normal exchange rate. Now let's talk about nominal effective exchange rate and real effective exchange rate. Okay, now near and rear. First let us see near, that is nominal effective exchange rate. Now here in the previous example, exchange rate we said rupee is to dollar, that is domestic currency is to a foreign currency. Here it is the value of domestic currency as a ratio or in comparison to a basket of foreign currencies. Now what is this basket of foreign currencies? It includes all the major currencies of the world accepted by IMF, which includes dollar, euro, pound sterling, then Chinese renminbi and also Japanese yen. So these strong currencies, and weighted average of this basket of currencies is to the local currency is the near or nominal effective exchange rate. Now what you can remember about near is that it is exactly the opposite of exchange rate. To make it more clear, for example, when we say the exchange rate of rupee is 85 is to 1, that is in order to buy $1 you need 85 rupee, and immediately it has increased to 90 is to 1 $1 you need 90 rupee. This means there is a depreciation of currency. So here you see a depreciation, but in case of near it's exactly opposite, which means an increase in nominal effective exchange rate indicates an appreciation of rupee. This is the first statement. So when near increases, rupee appreciates. That's what this first statement says. Now if you take it as exchange rate, instead of near, if you take normal exchange rate, not nominal, normal, the normal exchange rate, when there is an increase in the exchange rate, it means there is depreciation of rupee. When there is increase in exchange rate, it means there is a depreciation of rupee, and I said that in case of near it's exactly the opposite, which means that an increase in near means appreciation of rupee. This statement is actually correct. I am not going into much detail. We will take all these topics in detail in the module classes. Now the second one, an increase in rear. Now to understand this statement, we need to know what is rear. Now we have seen what is near. Rear is nothing but near adjusted for inflation. That means near minus inflation will give you rear. That is rear. It is simply near only, but it is adjusted for inflation. So the effect will be the same on rupee. An increase in rear indicates improvement in trade competitiveness. Now you see the first statement. An increase in near means appreciation of rupee. So definitely an increase in rear also will be equal to appreciation of rupee, right? The only difference is inflation. So here when there is an increase in rear, it should also mean appreciation. And do you think that when a domestic currency appreciates, it will help trade? No, our commodities become costlier in the international market. I'll explain all this differently. Now to understand the statement, when the when there is an appreciation of a local currency, it means that the value or the price of such commodities in the international market is high and there will be less demand for such commodities and therefore less trade competitiveness. So it does not indicate an improvement in trade competitiveness, whereas it will reduce the trade competitiveness of our commodities in the international market. So the statement is wrong. Third statement is very easy. An increasing trend in domestic inflation relative to inflation in other countries is likely to cause an increasing divergence between near and rear. So we know what is the difference between near and rear? It is inflation. Near adjusted for inflation is rear. Therefore, if there is an increase in inflation, the divergence will be high. That's correct. If there is high inflation, the value of rear will proportionately change. So this statement is correct. So answer would be 1 and 3. C will be the answer. Now next one is again a very important topic and a conceptual question. With reference to Indian economy, consider the following statements. The first statement, if the inflation is too high. Inflation is too high means the money supply is high. The Reserve Bank of India will buy government securities. Let's see the other statements as well. If the rupee is rapidly depreciating, RBI is likely to sell dollars in the market. If interest rates in the USA or European Union were to fall, this is likely to induce RBI to buy dollars. Now let's see each statement one by one. The first one, if inflation is too high, it means that the money supply in the market is too high. RBI is likely to buy government securities. Now, what is the impact of buying government securities? If RBI is buying government securities from the public, it means in return RBI will have to pay for it, which means RBI will have to pay the public and therefore money supply with the public will again increase or further increase. So, buying government securities at the time of inflation is not at all a good idea, because during inflation the money supply is already very high, and if RBI is buying securities from the public, RBI will again disperse credit or disperse money to the market, which will further increase the money supply, which is not at all good and which cannot be taken during inflation. So statement 1 is wrong. Now, if you know that the statement 1 is wrong, you get the answer directly, but that's not the point. We need to see the other two statements as well. Second one, if rupee is rapidly depreciating, that is the value of rupee coming down, RBI is likely to sell dollars in the market. Now, we need to understand what are the reasons the rupee or the value of rupee comes down or depreciates. Now, let's take rupee and dollar against dollar. Now, the first factor is demand factor. For any commodity, when the demand is less, its value will go down. Whereas, when rupee depreciates, dollar appreciates, which means that the demand for dollar is high. Then regarding supply, see, supply of rupee is very high. That's why when there is a excess of supply of some commodity, its value can come down. So supply of rupee could be very high. We are talking about depreciation, the scenario of depreciation, and the dollar supply would be very less during depreciation. You should know this thing. This is a basic, and if you know what happens to demand and supply of both the currencies, it's very easy to get the answer. And that's why conceptual knowledge is very important. If rupee is depreciating, RBI is likely to sell dollars in the market. Now, what will happen if RBI sells dollars in the market? RBI selling more dollars in the market means RBI will be increasing the supply of dollar in the market. Now see, when the supply of dollar in the market increases, what will happen? See, the rupee has depreciated because the supply of dollar is less. Now RBI is selling more dollar in the market, which means that the supply will further increase. So this will help out. That is, during depreciation, RBI will sell dollars in the market so that supply of dollar increases, therefore its value will come down and therefore rupee will appreciate. This is correct. Third one, if the interest rates in USA or European Union were to fall, that is likely to induce RBI to buy dollars. Now, when the interest rate in USA or European Union is low, which means buying credit from those places are cheap, right? When the interest rate is low, which means the credit or money is easily available in those countries. So this is a very common knowledge to understand, very common logic to understand that whenever the price of a commodity decreases, its demand will increase. So RBI will buy dollars because interest rates are low there and RBI could purchase it at a cheaper rate. So 2 and 3 are correct. Answer is B, 2 and 3. Now this is a factual question. So we will skip this question. Sorry. Yeah. With reference to Indian economy, what are the advantages of inflation indexed bonds? Now, we'll see the statements first. Government can reduce the coupon rates on its borrowings by the way of inflation index bonds. Sorry, this is IIBs. Inflation index bonds provide protection to investors from uncertainty regarding inflation. The interest rate received as well as the capital gains on IIBs are not taxable. These are the 3 statements. Let's see. First, let us understand what is an inflation indexed bond. Now, we know that a bond is a financial instrument, right? So, a bond is a financial instrument and interest has to be paid because it's a debt instrument and not an equity instrument. Interest has to be paid on bonds. Now, this is inflation indexed. What does it mean? It means that the interest rate of the bond depends on the rate of inflation in the economy. That is indexation. That is connection. Indexation here means it is connected to or it's correlated to the rate of inflation in the economy. Now see, regarding an inflation index bond, the interest rates go up when the inflation is high. Why? Because during inflation the value of money is less and therefore during inflation more interest will be paid. Now the interest rates will go down also when the inflation rates are low. When inflation rates are low, the value of money is high, therefore less interest needs to be paid. This is the mechanism of an inflation indexed bond. That is indexation to inflation. Like an increase or decrease in the rate of inflation can cause an increase or decrease in the interest rate. That is the idea of inflation index bonds. The first one, government can reduce coupon rates. Coupon rates here means interest rates on its borrowings by the way of IIB. Now, the borrowing by government is through government securities, which is also a bond. So, government can reduce the coupon rates. Yes, it is possible. How? When the inflation rates are low, the government can reduce the interest rates as well. So this is correct. IIBs provide protection to the investors from uncertainty regarding inflation. This is the very idea of IIB, that is during inflation the investors should be protected from the negative consequences. That is during inflation we know that the value of money is less. So you should be knowing about the real interest rate and nominal interest rate and all those things. So you can easily connect. So that is also correct. Third one, the interest received as well as the capital gains on IIBs are not taxable. Do you think that government will completely waive off the taxes for inflation index bonds? No, right? Now, if you do not know this fact, what are the logic that you can bring into your mind? First logic is that if the government is waiving off some taxes or if the government is giving some tax subsidies, it should be with the idea that government wants to promote a particular sector. Like for example, if the government is giving a tax exemption to the startups, government is focusing on increasing the number of startups. If the government gives some tax waivers to maybe food processing industry, let's take for example, it means government is trying to promote them. That's not the case here. Now, second logic that you can think is inflation index bonds are very good for the investors. That is, it gives the investors protection against the risk of inflation. So, it's already a very good idea. So, why should the government bear such a tax expenditure or a reduction in taxes? So, that will not be right. These are the things that you can think of if you do not know the fact. Now, this should be wrong and it's an extreme statement because interest as well as the capital gains, we know that capital gains is taxed. So you can eliminate it. So with that we get the answer 1 and 2. This is again a factual question, as well as this question is not very relevant now, so we'll just skip it. Now, which of the following activities constitute real sector in the economy? Now, what is meant by real sector? Real sector means some sectors or some subsectors in the economy which provides or which produces real output. That's how we classify a real sector. That is, sectors that produce real output which is quantifiable, which can be quantified. That is directly producing output. Now, farmers harvesting their crops. Crop is an output which can be quantified. So, this is real sector. Textile mills converting raw material into fabric. This is again a real sector because here the fabric is an output which is quantifiable. A commercial bank lending money to a trading company. Here the bank is providing credit and no quantifiable output is produced. Like here it's a financial sector activity where money is given or credit is given and no real output. So third one is wrong. Fourth one, a corporate body issuing rupee denominated bond. Here again it's a financial instrument and no real quantifiable output is produced, like which you can see or which you can quantify. So fourth one is also wrong. So answer would be A, 1 and 2. Now next question. Which of the following situations best reflects indirect transfers often talked about in the media recently? This was a 2022 question. So during that time, this indirect transfers were in the news. Let's see the options and let's try to connect the options with the statement. Now, an Indian company investing in a foreign enterprise and paying taxes to the foreign country on the profits arising out of its investment. Do you think there is some indirect transfers happening here? Like, let's take for example ABC, an Indian company is investing in a foreign company XYZ. Now, the Indian company ABC is paying taxes to the foreign country. Like, let's take for example, it's in UAE. XYZ is in UAE. So, ABC is paying taxes to UAE government on the profits coming from the investment in XYZ. Is there anything indirect about it? No. A foreign company investing in India and paying taxes to the country of its base on the profits arising out of its investment. This was again in the news, but this is related to BEPS or base erosion and profit shifting. We have heard about tax havens like Mauritius or Singapore. Like Indian company starting its headquarters or maybe the base in a foreign country, especially in a tax haven. Let's take for example an Indian company starting its a company established in Mauritius, and this Mauritius based company may be having a branch in India, and all the economic activities will take place in India, whereas they will be paying taxes only in Mauritius because the base is in Mauritius and the tax rates are very low there. That's why we call them as tax havens. This is base erosion and profit shifting, not indirect transfers. Third one, an Indian company purchases tangible assets in a foreign country and sells such assets after their value increases and transfers the proceeds to India. This is something related to capital gains. Next one, a foreign company transfers shares and such shares derive their substantial value from assets located in India. See here, you see that there is a transfer, and if you read it carefully, a foreign company transferring shares and the value of those shares are from India, or value of the shares are from assets located in India. So here you can see there is an indirect transfer, and answer is D. Now next one is a very basic question with reference to expenditure made by an organization or a company. Which of the statements are correct? This is regarding capital and revenue expenditure, very basic things, NCERT knowledge. Acquiring new technology is a capital expenditure. Now, what is the difference between capital and revenue expenditure? To explain it better, we can take capital first. Capital expenditure. Now, capital expenditure you can easily distinguish from revenue expenditure. by using these two maybe methods. First one, and a capital expenditure either should increase assets, the quantity of assets, or the second one is it should reduce liabilities. So if any of these conditions are met, we can say that it's a capital expenditure. Either it should increase the quantity of assets or reduce the liability share. Acquiring new technology. Do you think that any of this is applicable here? Yes, technology is an asset and therefore there is an increase in asset, therefore it's a capital expenditure. So first statement is correct. Debt financing is considered as capital expenditure. That is borrowing money. While equity financing is considered as revenue expenditure. Do you think so? No, equity means actually you are selling the shares, which is the which is actually capital in nature. So the second statement is wrong and the first one is correct. Answer is A. Okay, with reference to Indian economy, consider the following statements. A share of household financial savings goes to government borrowings. Government borrowings in the form of government securities. This is a very logical statement. That is, out of the total financial savings of households, a part of it goes to government borrowings. Simply, the examiner has asked you whether households can purchase government securities or not. Yes, retailers, households, all of them can purchase government securities. Second statement, dated securities issued at market related rates in auctions form a large component of internal debt. Now, dated securities issued at market related rates, that is again talking about government securities only. So, whether government securities form a large fraction of internal debt. We know that government has both internal as well as external debt. Borrowings from within the country is internal debt. So, the question is whether government securities form a large component of internal debt of the government. That is also correct. Answer is both 1 and 2. Again, we'll skip this question because it's factual. Next one, tight monetary policy of US Federal Reserve could lead to capital flight. Now, what is tight monetary policy? Which means an increase in the interest rates or contractionary monetary policy. Calibrated tightening. We call it as calibrated tightening. Capital flight may increase the interest cost of firms with existing ECBs or external commercial borrowings. Devaluation of domestic currency decreases the currency risk of ECBs. Now let's see. Tight monetary policy of US Federal Reserve could lead to capital flight. Now, when the interest rates in US increases, the return on investment, when the interest rate increases, the return on investment in US also increases. So, as a result, people who have or investors who have invested in many other countries would take their capital back and invest in US because they are following a tight monetary policy. The interest rates are high and therefore the return on investment is also high. So, this can lead to a capital flight. This is correct. First statement is correct. Now, second one, capital flight may increase the interest cost of firms with existing external commercial borrowings. That is, those firms which already has external commercial borrowings, this may increase the interest cost. That is again correct. Third one, devaluation of domestic currency. That means the value of domestic currency coming down. Devaluation decreases the currency risk associated with ECBs. No. Why? During devaluation, it's equal to having a currency depreciation. The impact is the same as of currency depreciation. So, during devaluation, the value of domestic currency or rupee comes down and therefore, as a result, the currency risk will increase. Why? Because during depreciation, the value of rupee goes down, and when you, in case of an ECB, when you have to pay back in terms of foreign currency, because the value of rupee is less, you have to pay more rupee in terms of foreign currency. So, this will increase the risk. So, the third statement is wrong. Therefore, the answer could be 1 and 2. Next one, in India, credit rating agencies are regulated by RBI. Credit rating agencies regulated by RBI. Second one, rating agency popularly known as ICRA is a public limited company. This is a factual statement. Maybe we know it, we don't know it. Then Brickwork Ratings is an Indian credit rating agency. So these are the 3 statements. Now the second and the third statements are purely factual in nature and you may know it, you may not know it. But the first one is logical and also you can work on the first statement with whatever knowledge you have. Now we know credit rating agencies. These credit rating is not done by RBI. What is the purpose of RBI? If you know the basics of RBI, you know that RBI is the monetary authority, regulation of banks, issuing currencies, all these are the purpose or the functions of RBI, monetary policy and all that. And when you, at least if you have read NCRT regarding RBI, if you have read the basic functions of RBI, you must be knowing that credit rating agencies does not come under the purview of RBI. So first statement you can easily eliminate here and with that, you get the answer 2 and 3 as correct. Next one is, with reference to Bank Boards Bureau, which of the following statements are correct? Before we move into this question, I would like to clarify that Bank Boards Bureau does not exist now and instead of Bank Boards Bureau, we have Financial Institutions Financial Services Institutions Bureau. Sorry, Financial Services Institutions Bureau. Okay. Now we'll see this question. The governor of RBI is the chairman of Bank Boards Bureau. This is not correct. Bank Boards Bureau recommends for the selection of heads for public sector banks. This is correct. The purpose was to nominate or to recommend the heads of public sector banks. It helps the public sector banks in developing strategies and raising capital. So 2 and 3 are correct. So this question is not much relevant, but I wanted to take it up because instead of Bank Boards Bureau, we have Financial Services Institutions Bureau, and the difference is that Bank Boards Bureau was responsible to recommend the names of those top managers to the top positions of the public sector banks, whereas Financial Services Institutions Bureau is a broader institution which covers under its purview not just public sector banks but also public sector insurance companies, securities market and also the Provident Fund market. So that's why it's a broader term and the answer for this question is 2 and 3. Please go through Financial Services Institutions Bureau, just read it because in the last 10 years or so, maybe UPSC has asked Bank Boards Bureau several times. Now, there is a chance that they can ask Financial Services Institutions Bureau as well. Next is regarding convertible bonds. Consider the following statements. Now, what is the idea of a convertible bond? Convertible bonds, bonds are debt instruments. Okay, convertible bonds means these bonds can be converted into equity instruments. So this is what we mean by convertible bonds. There is a flexibility of converting these bonds into equity instruments. See the statements. As there is an option to exchange the bond for equity, the definition is given in the statement itself. Convertible bonds pay a lower rate of interest. Second one, the option to convert to equity affords the bondholder a degree of indexation to rising consumer prices. Now let's see the statements. The first one, as there is an option to exchange the bond for equity, which means there is a flexibility for the investor. Convertible bonds pay a lower rate of interest. See, with flexibility comes reduced risk. When you have a flexible option, the risk is less. And we know in financial market, the basic principle is that when the risk is high, the return is also high. And when the risk is low, return also comes down. So flexibility means less risk. So what should happen? Less risk means less return. This is correct. Low rate of interest because it's flexible. The option to convert to equity affords the bondholder a degree of indexation to rising consumer prices. Here, the question is put a little complicated, but it simply means inflation. So, the option to convert to equity, when an investor has the option or flexibility to convert it into equity, there is a degree of indexation to inflation. This is also correct. So, answer is C, both 1 and 2. In India, which of the following is responsible for maintaining price stability by controlling inflation? This is the purpose, or this is the function of RBI, that is price stability, that is a reduction in inflation, and this is done through monetary policy. This is a direct question. Again, in India, which one of the following compiles information on industrial disputes, closures, retrenchments, layoffs in factories employing workers? CSO, Department for Promotion of Industry and Internal Trade, Labour Bureau, National Technical Manpower Information System. This is again a very direct question. You know, the purpose of CSO is to compile data. Then DPIIT is responsible for promotion of internal trade and industry. Labour Bureau, it should be related to industrial disputes, obviously. Let's see the last option, National Technical Manpower Information System. So, this is an information system. So, that should not be responsible. So, answer is 3, Labour Bureau.